For joining me, especially after the Financial Advisor Summit we just did together on CNBC. It's good to have you.
Likewise, Sarah. Go ahead.
So talk to us about your strategy from here, because you don't think the action is going to happen in the major averages anymore. Why is that, and what do you do instead?
Look, I think it's well known that valuations are very rich, and typically, the high valuations tend to be a precursor of the future returns of a stock market. People forget we had a lost decade from 2000 to 2010 in the S&P 500. If you look back then, you actually lost money from a capital appreciation standpoint. But if you invested in dividend yielding stocks, you actually made a positive total return over the decade. And I anticipate that that's the playbook going forward, which is why I am arguing for a repositioning of a portfolio to look at what is the dividend yield on that underlying portfolio. And if it's too low, you might want to reconsider repositioning.
Where are you finding these higher and rising dividends?
Well, I'm a stock picker at heart, so it tends to be highly curated. But the one thing I look out for is not just high dividend yields, but also whether they come with low debt. Because debt multiples are something that people don't look at. They only look at earnings multiples, and that's a mistake with the amount of corporate indebtedness. You saw in the case of General Electric stock a couple of years ago, the stock collapsed when people realized they had a lot of debt on the balance sheet. And of course, the dividend collapsed alongside. And you don't want to have a high dividend yielding portfolio, which is a head fake. So it's really important to pick those companies that have recurring dividend yields with low debt. Some of the best companies of that sort can be found in Europe, in the healthcare sector, in fast-growing spaces like oncology, cancer drugs, Roche, Novartis, Sanofi. These all happen to be European pharmaceutical companies, but they have strong balance sheets and a very reasonable, compelling dividend yield, 3 to 4% on average.
When we look at European stocks as a whole, often people point out the valuation multiple difference between European and US stocks. But what gives you confidence that that will really meaningfully change over the next 5 years or so? Could it not just prolong as it has done for most of the last decade?
Well, I'm not arguing for a re-rating of the stocks versus the US healthcare companies. I'm just saying they're undervalued. In fact, many US healthcare companies are undervalued too. I would generally argue healthcare as a sector is offering you a good combination of growth, but also income. Take Bristol Myers Squibb, for example, in the US. They also have a very compelling dividend yield. Gilead, is another example. So I'm not saying that opportunities in Europe alone, but I think the better opportunities in Europe, in particular in companies like Roche, because they are part of a very fast-growing end market like oncology, which offers you scope for disruptive innovation. And it's not just found in the US, it can be found abroad. So when you can get this combination of innovation and growth, and at a reasonable multiple, and with a strong balance sheet, why not?
There's a major vaccination gap, Ripple, happening around the world based on the country you live in, the access you have, the kind of vaccines you're getting. Do you expect that to drive returns in different countries? And are you wary of investing in companies in certain countries because of the low vaccination rates?
No, I think that it's just a matter of time. The world will figure out how to vaccinate itself or have herd immunity. In fact, we're already seeing it around us, which is why stock markets tend to be forward-looking mechanisms, despite the news, which is very well known about either the Delta variant or the low incidence of vaccinations, as you point out. Markets continue to go up. That's because they are forward-looking. They do not perceive this to be a problem, and I concur. It's a matter of time.
Ripple Bhansali, thank you for joining us. Good to get your take.
Thank you for having me.
Shepard Smith here. Thanks for watching CNBC on YouTube.